Well, as we reported earlier in this newscast, the Federal Reserve announced that it is raising interest rates by 3/4 of a point to try to combat inflation. And joining us now live to talk more about this is Sanjay Varshney. He's a professor of finance at Sacramento State.
Thanks for joining us. You know, this is an aggressive hike, the most aggressive in 28 years, and it's really expected to cause some pain. Some describing this as the Fed taking a sledgehammer to our economy to really shake it up. So where are people going to feel this the most?
You know, so while the rates typically take some time to trickle through the economy, the consumer, which is almost 70% of the economy, sees it first. So what's going to happen is, with the rate hike that we saw today, for example, you're going to see the prime rate spike, and the prime rate typically becomes the basis for other rates that the consumers see. So for example, when you're talking about the rates on credit cards, when you're talking about auto leases or automobile loans that consumers take out, personal loans from the banks, when you're talking about maybe the home equity loans they take out from the banks. So usually the consumer immediately feels the impact of a rate hike, whereas the rest of the economy might see a few weeks to a few months.
And so ultimately, then, the goal is to stabilize prices. How long will it be before we start to really see prices for things then come down?
So I think here there's a slight misunderstanding between what happens to prices and what the Fed does. The Federal Reserve can simply control the demand side of the equation. What they are trying to do by raising the rates is to slow down the economy, slow down the consumer spending, slow down the business spending. But really, the Federal Reserve cannot do much to fix the supply side, which is what we're talking about in terms of supply chain. We're talking about the commodity markets, for example, which have been impacted by the war in Ukraine. We're talking about how things reach the shelves, and that part of the equation, until that comes back into sync, we're not going to see prices immediately actually come down just because the Fed raised the rates today.
You know, one area of our economy that's been a bright spot has been the job market, unemployment rate being so incredibly low. But how do we think this is going to impact the job market with these interest rates going up?
It's already happening. So the Federal Reserve obviously wants to see more impact in terms of the businesses slowing down their part of the spending. So what's happening is massive layoffs have already begun. I'm sure if you're watching the news in the last several weeks, big tech companies, mid-sized companies have announced that they are doing layoffs. And the Federal Reserve understands that as they're raising the rates, it is going to have an impact on the labor market. It is going to result in businesses feeling the pressure because of the higher cost of borrowing. And in turn, the businesses basically in an effort to basically streamline their budgets will trim down their labor force. And that means more layoffs.
But with so many jobs open right now, perhaps that'll help balance things out a little bit with getting people into these jobs.
That is the hope. The hope is that because our labor market is the best labor market we have seen in over 50 years, the unemployment rate right now is close to about 3.6%. So as the Fed is raising the rates, the hope is that the impact, even though we understand that the unemployment rate is going to go up, the Fed basically is expecting the rate to maybe go up to about 4.5%. And then that should allow enough time for inflation to come down and for the Fed to be able to engineer a softer landing. Of course, the Fed has a track record of always being too late and doing too much. So that's the fear, that raising the rates as aggressively as they are doing right now, it was supposed to be 50, 50, 50 in the next 3 meetings. It looks more like 75, 75, and 50, and maybe 25 and 25 more before the year is over, because the bond market is predicting that the Fed rate should be at about roughly 3.5%. And the Fed exactly said that today, that their target is 3.4% for the year.
All right. Well, we appreciate your expertise. As always, Sanjay Varshney, thanks so much for joining us.
My pleasure.